Mergers and acquisitions happen all the time, everywhere. Perhaps 20,000 large acquisitions a year in Europe and USA each. That is why we need a whole industry of M&A lawyers and advisors like Goldman, Merrill, Morgan, and the rest of them. These people maybe make 2% to 4% of deal value each year in commissions. Hence, in a $1 billion deal, they will make something like $40 million. A lot of bonuses to the bankers involved. Here in this session, we teach the accounting for M&As, which many of you will find quite useful in your careers. Look at this deal. Big wants to acquire small, and they are willing to pay 25 to acquire assets worth 100 and an equity value of 20. They will also assume the liabilities of the purchased company. So once the M&A is over, how do the financial statements of the large company look like? The process is simple. When you do an M&A, you add the assets and liabilities of the acquired company to your books. The cash leaves. So you have new assets of 100 and new liabilities of 80. So new net assets of 20 is calculated as 100 minus 80. Subtract cash of 25. And the numbers you got are assets of 1,075 and liabilities and equity of 1,080. Numbers do not add up. Why? Well, it is simple. You paid 25 and you got net assets of only 20. So 5 is missing. The numbers do not balance. So what is missing? What is missing is an account called goodwill, and the value for it is 5. The formula to calculate goodwill is the price you pay minus the net value of the assets you acquire. Here we paid 25 and got 20. So the goodwill is 5. What does this goodwill represent conceptually? Goodwill means that we paid 5 more today because we expect at least 5 of benefits in the future. These future benefits are an asset and it is called goodwill. This is logical. Why would you pay 5 more today than what you acquire? Because you expect at least 5 of benefits in this future of this M&A. Better customers, new supply chains, new technology, great management, new expertise, the whole 9 yards. There is a million good reasons why you want to do an M&A. And goodwill is the account that represents the excess of what you pay over what you acquire. Add the goodwill, do the math, and you see now everything balances. Now one thing you need to keep in mind is that when we do an M&A, we do not add the equity of the acquired company to our balance sheet. Look, you purchased assets of 100 and liabilities of 80. So you purchased the net value of 20. You are adding this 20 to your balance sheet. Once you do that, you do not add another 20 again. If you add 20 again, you have a total of 40. You paid 25 and you got 20. Add them. Just do not add them twice by adding the equity again. There are 2 main types of acquisitions for something to count as an M&A. When you purchase more than 50% of the shares. You can purchase 100%, and that would be a full M&A, or you can purchase anywhere from 51% to 99%, and that would be a partial acquisition. One way to do the accounting is to do a net asset or a book value method of an M&A accounting. This has a specific goodwill calculation method, and also one for minority interests, which I will discuss soon. The other way to do accounting for a partial acquisition is the fair value method. Finally, if you purchase 80% of a company for $100, how much would it have cost had you purchased 100% of the shares? Well, the answer is you divide the 100 by 80%, giving a value of 125 had you purchased the full company. Let us start with the book value method, also known as the partial method. If you purchase 80% of the company for 25, then goodwill is 9. You pay 25, but you got only $16 of equity purchased. Hence, you paid an extra of only 9. The proportion that you did not purchase, the 20%, will have a value of 20 multiplied by 20%, and that would be 4. We call this the non-controlling interest, NCI. So how does the balance sheet of the new company look like? We will have goodwill of 9 under assets, and an NCI of 4 under equity. So what does the NCI represent conceptually? This is quite complex, so please pay close attention. We purchased 80% of a company, and notice that we add 100% of the acquired assets and 100% of the acquired liabilities. Why do we add 100% of what we acquire if we are only acquiring 80%? Well, this is because accounting wants to show control. What does the new company control? It controls 100%, even if it owns only 80%. If you control 100%, then the scale of your company is 100%, even if you own only 80%. Many companies only do partial acquisitions. I have seen once a presentation where Volkswagen owns more than 1,000 companies globally, and a lot of them are acquired partially. It controls all of them. Hence, the size of Volkswagen is huge, and their extent of control is big. Now, given that accounting shows the assets you control and not the assets you own, then if you add 100 of assets, then you need to show that 4 of these assets do not belong to you. In other words, we added net assets of 20, which is 100 minus 80. From these 20 of net assets that we added, 4 do not belong to us. These 4 belong to some other investors outside the company. NCI means that there are other investors that own part of your assets. Full stop. Simple, simple. Do not overcomplicate it. When you are doing an equity valuation, please note that your total equity includes external investors that need to be subtracted. Next, I will show you the full goodwill method. This full goodwill method is mandatory in the USA. In Europe, we can use both full goodwill and partial goodwill under IFRS. In the full goodwill method, if you purchase 80% of a company, the goodwill is calculated as a proportion of the value of the new value of the company, and not as a proportion of the value of the old company. In other words, the company prior to the acquisition had a value of 20. In the partial goodwill method, you calculate goodwill as a value of this old 20. In the full goodwill method, you calculate goodwill as a proportion of the acquired value of the company, which is a 25. So the full goodwill method is a more market value method. And as a consequence, both goodwill and minority interests are larger than what they would be under the partial goodwill method.